Okay, so start recording, and I'm gonna share my screen because I have a banner here. That was bad. I think I'm just gonna leave it this way. That's fine.
Hi.
Hello.
Yeah, can anybody hear me?
Yes. So.
Okay,
yeah,
so I do have slides.
Oh, okay.
And so I'm not sure how I can share that.
Yeah, I just don't see who is speaking. Who is speaking now?
Maud.
Oh, Maud. Oh, I see you now.
Yeah,
Perfect.
he's a discussant for
Make a co-host. All right, excellent. Okay, I think it's about time now. So welcome everyone.
I'm going to, how do I share my slide? I have some slides.
So you're co-host now. So probably you're gonna see a share your screen button on your Zoom.
Yeah.
So if you click on that button, we can try that now real quick.
Yes, please.
Yeah, so if you can click on that button.
Okay. I'm not sure. I hope my work system allows me to share screen. Are you seeing my screen?
Not yet, but I probably have to stop sharing my screen. Maybe that's why. So I'll stop sharing my screen. All right, try to share your screen now.
Are you seeing it?
I am not.
Okay.
Did you click on share screen?
Yeah, I did. But if I'm not able to.
We can, Maud, you can, one thing we can do too, if you send me your slides, I can share my screen with your slide when it's your turn to discuss.
Okay, so how do I do that?
I'll send you my email via chat, and then you just, okay? And then when it's your turn, I'll share my screen, and then you can
Can you just give me your email to send to you right now? Because I have a million things and I just need to send it to your email.
Sure. Let me just do the first introduction and then I'll share my screen. I'll send you my email. Okay. All right. So thanks everyone for coming to our first seminar on the topic of unbanked households, poverty, and taxation. We have until 2 p.m. So that's why I really want to start this on time. I just have a request for the audience is to keep yourself muted until we get to the Q&A section of the seminar. And then with that, I'll pass to Brian, who is the chair of this section. So please go ahead, Brian. And I'll send the email right now. Thank you.
Great. Thanks so much. Really happy to be here to chair this session today. I'm Brian Melzer from the Tuck School at Dartmouth, and the topic today will be the causes and consequences of being unbanked. We have a great set of papers. The format will be 2 hours in total. We've got about 20 minutes for each paper, 5 minutes, that's for the presenter, 5 minutes for the discussant, and then 3 minutes for Q&A afterwards. If you have questions as you go along, you can type them into the chat. If people don't otherwise interject, I'll raise some of the chat questions in the Q&A period. With that, let's get started. Our first presenter will be Claire Salarié from University of Toronto, presenting on the impact of financial inclusion on minorities.
So I hope you can see my slides. So hi everyone, thank you very much. It's a great pleasure to be here. So I'm going to talk about the impact of financial inclusion on minorities through the lens of history, because we're going to talk about the Freeman's Savings Bank. So, so the literature has explored the effects of access to basic financial services on employment, income, wealth, and education. But so far, little is known on how financial inclusion affects minorities. We also know that racial discrimination leads to poor economic outcomes. So the question is, what is the role of financial intermediation? Can fostering access to financial institutions have negative impacts on minorities? And if yes, how? So to address this question, we're going to focus on the history of the Freeman Savings Bank. So this bank was chartered by Congress right after the Civil War in 1865. Initially, it was a simple savings institution targeting recently freed African American populations. And the bank collapsed in 1874 because of mismanagement and fraud. And so we find evidence suggesting that the Freeman Savings Bank amplified the discrimination. So what is the mechanism? So we show that the bank collected deposits through an extensive advertising campaign, relying on exhortations and promises, with no comparison with other banks. And then what we show is that the deposits collected from the freedmen were transferred to white populations through speculative loans. And finally, our last result is that the collapse led to depositor losses that have rarely been matched in the banking history of the US. So I'm going to go quickly through the literature, but basically we contribute to the literature on the cost and benefit of financial inclusion, the role of how financial institutions use advertising and sometimes to exploit consumers, and the impact of discriminations in financial institutions on the racial wealth gap. We also contribute to the literature on the Freeman Savings Bank. So there is literature from history collecting facts about this bank, and so we contribute to this literature. And we also add to a recent paper published in the Review of Financial Studies documenting very large positive effect of the bank in the short run. And so what we show is that when we replicate the analysis, we cannot find any evidence of these short run effects. And so our paper cautions on the risk of misinterpreting the historical context and like the challenges of using historical data. And then, of course, when we think about this episode of history, about potentially diminishing the suffering of highly discriminated populations. So I'm just going to go quickly through the data we exploit and give you a bit of background about the Freeman Savings Bank. And then I'm going to show you our results on the advertising and the wealth transfer from the freedmen to white populations. So in terms of background, so what is the Freeman Savings Bank? So as said, the bank was chartered by Congress right after the Civil War as a simple savings institution. So the objective was only to collect deposits and also to teach the freedmen lessons of thrift. So the bank initially the bank was created and managed only by white officials and businessmen. Within 7 years of its formation, the bank opened 37 branches across 17 states and the District of Columbia, and collected deposits from around 100,000 households. So initially, the bank started with well-meaning intentions, but also with some disregard relative to African American populations. But then quickly, like after a few years, the bank started making speculative loans, mostly to white businessmen. And it finally led to the collapse of the bank in 1874. So this is just like a map of the US to illustrate the location of the bank branches. So they were mostly located in counties with a significant level of wealth per capita. And so in terms of data, so we exploit the registers of signatures of the bank. So for 27 branches, we have information on each account that has been opened, like the account number, the identity of the account holder, and the race. So we exploit this information. We also have data at the loan level. So when the bank collapsed, they collected information on all the outstanding loans. And so we're going to use this data to see like how the funds were allocated across race and locations. We also exploit census data to identify the race of borrowers, but also the characteristics of depositors. So we exploit the 1870 census. And then we also collect a data set on all the failures of commercial banks in the US until the creation of the Fdic to compare like the impact of the failure of the Freeman Savings Bank on depositors with the failure of other banks in the US. So now let me talk about our results. So a bit of context. So we're going to look at to which extent the advertising of the Freeman Savings Bank is amplifying discrimination against African American populations, and also like how the bank used advertising to collect deposits. So a bit of context about advertising in the 18th century. So this is really the period when advertising accelerated in the US and was shifting from being purely informational to being like promotional. And the main channel of promotion was the newspapers. And so what we're going to show is that the content of the advertising of the Freeman Savings Bank was really unique. And in fact, the founder of the bank was quite visionary. He really had like an advertising strategy targeting African American newspapers, for example, to advertise the bank as much as possible. So the first result we have is that we can show that the advertising of the Freeman Savings Bank was really extensive compared to other banks. So for example, if we take the main African American newspaper in this period, so the New National Era, which was also Frederick Douglass newspaper, we find that on almost every issue, out of 4 pages, half a page was about the Freeman Savings Bank. And so it has no comparison with any other bank in this journal. So we find almost no advertising of other banks in this journal, but also any other institution advertised potentially in this journal, even if we compare to the Freeman Bureau or schools, for example. And also we find no other bank in other journals with such an extensive advertising during the period. And so I went quickly through the advertising data, but basically what we did to collect newspaper articles. So we've listed all the digitized newspapers targeting African American during the period. And then we also have listed 2 or 3 main newspapers within each state. So we focus mostly on 4 states. And then we have focused on 2 or 3 newspapers with general audience in these states to have a control group. And also to build our control group, we also have like identified comparable savings bank in the same states to collect also the advertising. And so at the end, we screened close to 15 newspapers. We screen each issue, and we collect any advertisement or notice about any banks during the period. And at the end, we collect close to 1,100 articles. And then what we do to identify the content of these articles and compare the advertising of the Freeman Bank with other banks, we do a textual analysis. And we use word categories from the Harvard Inquirers to identify different types of content. And so we're going to distinguish advertising that is purely informational with advertising that is promotional. And then within advertising that is quite promotional, we are going to identify different type of content, like whether the ad is using positive wording, overstatements, or even false promises or exhortations. And what is very specific to the Freeman Savings Bank, and this is what I'm going to show you, is that they were using a lot of false promises and exhortation to advertise the bank with absolutely no comparison with other banks during the period. So I'm just going to give you an example of the false promises they were using in the advertising, as well as the type of exhortations or moral statements. So for example, an article would say, so there were 3 types of promises, basically, about a government guarantee, about the safety of the funds, and about the prosperity of the bank. So about the government guarantee, an article would say there is no possibility of loss for the reason that the government of the United States is responsible for every dollar deposited. And so in fact, the bank was a private institution and with absolutely no government guarantee. And when it failed, the depositors, they just faced losses. And so everything in the marketing of the bank was made to have the Freeman believe that the bank was backed by the government. And so, for example, the type of images they would use in a deposit book, the words they would use in advertising, and so on, were all giving this idea of a government guarantee. So we identify like the articles that are mentioning this idea of a government guarantee. So about the safety of the fund, an article would say, we offer advantage which are in fact unsurpassed. All money left with us is safe. as secure as real estate security. So in fact, starting from 1869, the banks started making large speculative loans. And so there is clearly a mismatch between how they were describing the use of funds of the bank in the advertising and how they were concretely using the funds. So there was absolutely no transparency, but they were investing in very risky loans during this period. And then about prosperity, so the advertising was claiming that the bank was highly prosperous. An example is a good sign. The Freeman's Bank, the Freeman Savings Banks are reported to be in a prosperous condition, while in fact the bank was in deficit almost every year, if not all years. And so what you see in blue is a type of are the words or the group of words that we use to identify these type of false promises. As a marketing, what another striking fact about the advertising of the Freeman Savings Bank is that it was using a lot of exhortations or moral statements. And so they were referring to religion, vice, or authority, and duty. So an example, mark this that industry, sobriety, economy, and a good moral character lead to wealth, education, influence, and power. About vices, the man who is a whiskey drinker soon becomes a needler, loses all his work, he and his family become ragged and miserable and have to be kept from starving in the poorhouse. They were also referring a lot to religion, like, for example, the blessings of the savings bank system, blah, blah. And also to figures of authority, such as Benjamin Franklin, Abraham Lincoln, the General Howard. So the philosopher Benjamin Franklin gave us a method for making money, plenty the following. So what we do is that we identify these advertising that are including exhortations. And so as said, it has little comparison with the advertising of any other banks. So this is the example of the advertising of two other banks. And the content was really much more informative, listing like the branch opening hours, the directors in the branch of the bank, and the cashier of the branch, and so on. So with our textual analysis, we can quantify the gap between the advertising of the Freeman Savings Bank and the advertising of other banks. And so just when looking at pure statistics, much more articles are purely informational for other banks than for the Freeman Savings Bank. So most of the advertising of the Freeman Savings Bank is really promotional, which is quite like visionary for this time. This is exactly the years when the marketing is shifting from informational to promotional. And it's as if the Freeman Savings Bank was already like a marketing in a promotional way compared to other banks. And then when we look into the content, they were using much more positive words, overstatements, and promises and exhortations than any other banks. And if we look at the time series, there is an interesting parallel trend in like the distribution of fraudulent loans and the use of moral statement in the advertising. Okay, so they increase exhortations when exactly there was a lot of fraud in the bank, and so they were making a lot of moral statements to depositors while they were making fraudulent loans to other populations, and mostly white populations in Washington, D.C. So then we look at what is the effect of the advertising on the collection of deposits by the bank. And so we regress. What we do is that we look at the advertising across 4 states, and we look through local journals. So we can have branch and year fixed effect and look at what is the effect of new articles on the collection of deposits at the branch. So so we're not making any causal statement here, but we do find a correlation between like the number of new accounts that are open and the number of articles over the last 7 or 14 days. The effect is larger for long articles, and also for articles making false promises. Okay, so now that we have documented like how the bank was heavily using advertising to collect deposits in using exhortations and false promises, we're going to look at the like transfer of wealth from depositors to white populations in so the bank was not supposed to make loans. It was supposed to be only a savings bank. But as early as in 1867, they started making fraudulent loans. It's because the management of the bank changed, and the new trustees had a lot of connections with investment bankers in Washington, D.C. And so what we do is that we use a low-level data set to identify the race of borrowers by merging it with the census data. So in short, because I don't think I have much time left, this is our main results. So while 92% of the depositors were African American, most of the loans were made to white populations. So 85% of the borrowers are white. And another interesting fact is that the depositors were mostly scattered across different states in the South, while the money was directly transferred to Washington, D.C. So most of the borrowers are in Washington, D.C. So the money was collected from the Freeman and transferred to white businessmen in Washington, if I simplify. So we could ask whether or not it's efficient. So it's what we document is that at least 30% of the outstanding loans were purely fraudulent and related to corruption and conflict of interest. Almost all loans were violating the charter of the banks, and like the depositors did not benefit from this risky investment by getting higher returns at all. Then what we do, and I think I'm short of time, so I'm just going to show you this final result. So we compare the losses to depositors in percentage of GDP to the losses of depositors across other bank failures in the history of banking in the US. And even when we compare to commercial banks, which are supposed to be riskier than a pure savings bank, we find that the Freeman Savings Bank, in terms of losses to depositors, in the top 95% percentile. And in fact, like the controller of the currency fought during 40 years with Congress to try to have the depositors reimbursed, and it largely failed. So our empirical results are quite consistent with historical accounts. So Frederick Douglass, for example, said that the bank has been the black man's cow, but the white man's milk. Or Dubois said not even 10 additional years of slavery could have done so much to throttle the thrift of the freedman. So it's time to conclude. So in this context, financial inclusion is associated with extensive advertising dealing with exhortations and false promises. And at the same time, there were like large information asymmetries on the health and investment of the financial institution and some governance issues that gave room for exploitation of discriminated populations and minorities. And then if we think about the possible policy implications, so there is this debate about formal or informal finance, because it's important to have in mind that before the Freeman Savings Bank, the African-American populations were saving, but through informal ways, like, for example, through churches and so on. Then there's also the importance of the governance of financial institutions serving minorities. It might be even like governance might matter even more in this context. And also there is this debate about the possible benefits of Black-owned banks. Thank you very much.
Great, thanks, Claire. Our discussant is Jesse Brune from Brown University.
All right, I'm trying to share my slides. Can you all see them?
Yes.
Fantastic. So first, let me just say thank you so much to the organizers for inviting me here to discuss this fantastic paper. My name is Jesse Brune. I'm an assistant professor in the economics department at Brown University. And let me just start by trying to think about this paper a little bit in context of the broader literature. Okay, so as you're all aware, there's this rich literature on financial services. You find that sometimes, like things like behavioral devices can increase savings rates. You find impacts of informal savings technology in developing countries on health and preventative health spending. But the impact isn't uniformly positive. There's this sort of resounding null effect of the benefits of microcredit. And often a rich literature on sort of predatory lending practices targeted towards the poor and minorities, poor and minority populations in the United States. And I think as kind of an outsider to this literature looking in, learning about this as part of reading this paper, my impression is that the places where these financial services tend to work better is when there's a small power imbalance between the individuals doing the lending and the individuals or providing the financial services and the individuals who are receiving the financial services. And I think this paper makes this point really nicely in kind of a case study fashion. So what does this paper do? They build a painstakingly rich and novel data set of bank branches, loans, depositors, and advertisements coming related to the Freeman Savings Bank. And I don't think they gave themselves enough credit in the talk. Believe me, they moved heaven and earth to put this data together, and it is wildly impressive. They also take an enormous amount of care to make sure that their analysis lines up well and is informed with important historical and institutional details. And I think they provide very compelling evidence of this episode in American history where the predatory nature of lending was deeply connected to race and power imbalances in the South. And finally, the sort of punchline is it's bearing witness to this enormous transfer that occurred as a result of the bank's collapse and this historical injustice that resulted. And I think it's just important to document these cases and make sure they're widely known. So just very impressive all around. I have two thoughts about things that I think could improve the paper. Let me walk through those. And I think the first is that the paper is currently kind of framed as like an existence proof. The research question, as stated in the introduction, is can fostering access to formal financial institutions have a detrimental impact on minorities? And relatedly, the paper spends a lot of time talking about prior work by Steen and Ian Ellis. And I worry that the paper is trying to find its voice a little bit as an independent contribution relative to sort of the commentary on the prior literature. And I wonder if there's a way to take this case study and really make that broad point about power imbalances and use it to try to explain some of this heterogeneity that you observe when you look at the impact of providing financial services in different contexts, places, and time periods. So that's one thought. But I think more broadly, it would be nice to connect the case study that you're so painstakingly documented to some of these broader themes in the literature. The second concern I had, or the way I thought the paper would be improved, for me, kind of the key empirical result that makes this case that you want to make, or an important piece of the theory of action, is you have the wild promises in the advertising. You want to show that the advertising is related to take-up of these financial services, kind of these predatory claims, and then document the fallout when the bank collapsed. And I worry a little bit about this regression. So just reminding everyone what we saw a few minutes ago, you have the number of new accounts in branch B at time T, the number of advertisements over the last 2 weeks that occurred in that bank's branch area, month fixed effects, year fixed effects, and branch fixed effects. And I realize you're not making a causal claim here, but if I simplify this regression a little bit, and I just imagine that there's only one branch in 1 year in your data, it's still identified, and it looks like this. It's effectively a time series regression within month, comparing the number of advertisements to the amount of new accounts. Okay, and I worry that a lot of your power is in practice coming from these comparisons, and I think there's a lot of reasons why you might find a correlation leveraging this data that aren't related to that theory of action that you articulated. For example, are more newspapers published in your payday? I think my preference would be to see this specification with branch and time fixed effects and really treat this as an exercise in like comparing trends. And you were upfront in saying that you weren't trying to interpret this causally, but I do think it would make your case stronger if you could show us some robustness to some other reasons we might expect to find these correlations that aren't related to your theory of action. Okay, and I think just returning to the paper for my last slide, as I said at the beginning, there's much to admire here, just this incredible data work, a timely important topic, and this excellent knowledge of the institutional details that form the analysis. And I want to thank you again for the opportunity to discuss it.
Terrific. Thanks, Jesse. We have time for a question, possibly two. Are there any questions from the audience? Otherwise, I can fill one in from the chat. had one question from the chat for Claire. Did the experience have a differential impact on the extent of being unbanked over time thereafter? Is that something you were able to look into or track subsequent to this event?
So I guess you're mentioning like the long run effects of the experience and the probability to be unbanked because of mistrust. So this is not something we investigate in the paper. It's unfortunately like there is really like a data challenge to do that properly, because we don't observe the information in the census. So this is a very important question, but we don't observe the information in the census.
Thanks. And then Melvin, why don't you unmute yourself and you go ahead and ask your question. So I guess Melvin is not responded. With that, I guess we'll let's transition to the next paper. For our next presentation, we'll have our presenter is Mark Kutzbach from the Fdic, presenting on the effect of job loss on bank account ownership. So Mark, why don't you go ahead and share your slides and go ahead and proceed with your presentation.
Great. Thank you very much, Brian. Thank you for the organizers and other presenters and discussants. So this is joint work with Ryan Goodstein of the Fdic. And what we're looking at is the effect of bank account of job loss on bank account ownership. And I'm just trying to get the bar out of the way. Okay, thanks. So I can see my slides. Okay, thanks. So the views expressed here are those of the authors and not those of the Fdic or the United States. So this figure shows the unbanked rate among US households. In 2019, about 5.4% of US households were unbanked. Unbanked is when no one in the household had a checking or savings account at the bank or credit union. And so there's been a secular decline in the unbanked rate in recent decades. And most of that has occurred in times when the economy was expanding. It's tended to slow or reverse a little bit in times of recessions. This is a limited time series, but that's one of the kind of the overall associations with it, the trend and some of the dynamics in recent years. Using the SCF and the Fdic's supplement, which I'll talk more about. And so this paper is focusing on unbanked because we think it's a important problem. Bank accounts offer households some important services, deposit insurance and other consumer protections, a way to save time and money when conducting financial transactions. They facilitate access to credit products. It's possible that for some low-income households who might not have credit access elsewhere in the formal credit system, they may be able to find access through their bank if they have a bank account. Bank account ownership has been an important focus of public policy and for regulatory agencies. Efforts at financial inclusion. Fdic has a committee on economic inclusion and has had recent awareness campaigns about benefits of having a bank account, and a lot of government benefits come through bank accounts. So there's efforts to develop bank accounts that might facilitate access for those who would otherwise be on the margin of being banked or not being banked. So we're going to look at one. There's many reasons why a household might not be unbanked, and relating to institutional reasons, the cost-benefit analysis, behavioral reasons, financial literacy, and we're not going to be able to get into all of that with this paper, but we're going to look at something that we think is maybe especially related to some of the cost-benefit analysis parts. A shock to employment that might affect bank account ownership. So many households, about 4 in 10, do not have a large amount of savings or sufficient cash to cover about $400 in emergency expenses. And so these households with little or no net worth might be especially affected by an employment shock, even if it doesn't last that long. So one aspect where it may affect them is account maintenance fees. These are often waived if you can maintain a minimum balance or if you have direct deposit to paycheck. And so, if you dip below that minimum balance or don't have direct deposit, those fees might impact more, and that might affect the cost benefit of maintaining a bank account. Also, households, when they're especially low on funds, might seek to have more direct control of their payments and avoid fees associated with missing payments, and so they might opt more towards money orders and check cashing. So our contributions, we're going to be bringing together the FDIC's supplemental household data set with monthly employment data. And that's going to let us look at dynamics of household labor force participation and at the same time, responses to questions on bank account ownership and use of financial services. And so, we're aware that there's potential endogeneity issues. For example, a household with lower educational attainment or financial literacy might be more likely to take jobs that have a high turnover rate and also less likely to open a bank account. And so we're going to try and address that as best we can with the data we have. A lot of the prior research on this topic is cross-sectional in nature, looking at associations with being unbanked with demographic, social economic characteristics, and there's not much longitudinal research on this topic. There's a paper by Ryan and Green that uses the SIP, and they actually do look at job loss and entry into being unbanked. That paper doesn't look at doesn't really address selection into job loss, and so that's one of the things that we're going to try and do with this paper, looking at differences in the timing of job loss among households. So we're going to focus on lower income renter households. That's about 20% of households, 70% of the unbanked. We find some economic and statistically significant effects of job loss on reduced bank account ownership. The effect is about 3/4 of the sample mean of the unbanked rate. So those are fairly large effects. And we find some evidence of persistence a year later. We look into this, pecuniary mechanism that is one of the motivations. We find that for the lowest income households, the evidence is strongest. And then we also find some evidence of increased use of non-bank financial services. And so one of the challenges we're going to have with this research is the sample size from this survey. And the fact that we don't actually have a longitudinal observation on responses about financial services. We'll just be using a single response for households. So, ideally, we would have longitudinal, but we'll use the dynamics of households' financial circumstances, from their employment as best we can. So the two data sets, the FDIC has a survey of household use of banking and financial services. That's been, we'll call that BFS hereafter, that's been administered from 2011 to 2019 in June. It was also in 2009, but we're not using that year because it was a different month. That includes, so that's a household level survey, and we've done analysis with it previously at the FDIC and found associations of unbanked with lower income household, less educated, Black and Hispanic, more volatile income. And it also asks about financial services use. We'll be linking that with the current population survey, which has data on demographics and employment. And so we're focusing on renter households with household income less than $40,000 a year. We think those are the households that would most likely be, immediately financially impacted by job loss within the household. And so we'll link together this financial services cross-section. In this figure, you can see in June, that is the highlighted column. That's when this supplement is asked of households in CPS. And we'll mainly look at 3 rotation groups that intersect with it. They'll intersect with it in their second month, their third month, or their fourth month in the CPS. So CPS, you're in it for 4 months, then you're out of it, and then you're back in it for 4 months a year later. And so we'll make some use of that later group as well, as we'll see. So our empirical specification, we're going to be looking at an indicator of whether a household is unbanked in their survey month, how that depends on job loss in that month or the months just ahead of that. We'll control for demographic and income characteristics of the household, as well as time and rotation group effects. And so we'll look at a couple of different counterfactuals. So the first panel here is our measure of treatment. This is households experiencing job loss. So we're requiring that they had an individual who was employed in the first month and then became unemployed in the second month. So they were not employed, and they reported they were searching for a job and unemployed. And we'll be comparing those with 2 sets. Control group A is households that remain employed. So this is households where all of those persons employed in the first month stayed employed in the subsequent months. And control group B is what we call our subsequent job loss sample. That's households that had a job loss a year later. So they were employed in month 5, and then they became unemployed in the month after that. So we think that some of the characteristics that might be associated with job loss that maybe we can't control for, might be the same in that subsequent job loss panel as in the first job loss, as in our treatment panel. And so, we hope that that's we're leveraging that as sort of a advancement to more cleanly identify our effects. So some summary stats here. The first column here is the treatment sample, and then we have the 2 control samples, and you can see the sample sizes there. So this is across these 5 panels of our data. We got 179 households that had a job loss, 103 that had a job loss a year later, and 5,409 that remained employed. And so we'll be comparing the treatment with each of those 2 controls. And we do notice some differences. The treatment group had a larger share of Black non-Hispanic households, for example. It's a little hard to tell because of our sample size, how much those might be actually potentially selection differences versus just a reflection of the sample size. But we'll look into that in our results a little bit. So our main result is that in the panel A, the remain employed group, we have an effect of 16.9 percentage point increase in the unbanked rate in response to job loss compared with the remain employed sample. That's in column 1 if you don't have any controls. If we add all of our demographic and household controls, that goes down to a 12.5% effect. In the subsequent job loss sample, there's also positive effects. If you look at the percentage below that relative to the sample mean, those are pretty large. It's about 3/4 of the sample mean, the size of the effect. So we'll look at some heterogeneity now. When we interact job loss with whether the household was in the higher income portion, 20 to 40K of that, the income bands, available for our sample, we see that that substantially mitigates any effects. Really, most of the effect is for the lowest income households. Also, we'll interact with race ethnicity. We find positive effects for white non-Hispanic and black non-Hispanic households. We don't find effects for Hispanic and other race households. But so it's not that, there's just one demographic group we're finding this. It is, it's with demographic groups covering, over half of the unbanked sample. And this is the results in the subsequent job loss group. So looking at the persistence a year later, we find that job loss, if you look at the households that experienced that job loss and look at the responses of households that responded in the second rotation in months 5 through 8 of their CPS rotation group, we still see some persistent effects. But in columns 3 and 4, you can see that if the household was reemployed, then there's in that later year there's no effect. If they remained unemployed, there is still a substantial lingering effect on being unbanked. That's somewhat descriptive evidence, but there's some possibility of persistence there. Looking at the non-bank services, we find the strongest evidence that the job loss was increasing use of money orders and check cashing. We also find some evidence of increasing use of pawn shop loans. We don't find any increase in payday loans, which would make sense because the payday loans require you to have a bank account and usually a paycheck. So those probably wouldn't be accessible. Also, looking at person level effects, the survey actually asks at an individual level whether you had a bank account or not. And we look at whether the individual had a job loss or whether someone else in the household had a job loss. And so for our remain employed sample, we find a larger point estimate of one's own job loss, the 0.186, on that individual being unbanked versus the other person's job loss, that's the 0.115. In the subsequent job loss panel, we find a substantially larger effect of one's own job loss. And so this sort of points to the mechanism that when you no longer have income and direct deposit from a job, there's less of an incentive to maintain the account of the person who maintained that job. We do some analysis of whether households cited a financial or non-financial reason for being unbanked. For example, like not having enough money to keep an account. In the remain employed sample, we do find that the job loss is more likely associated with the financial reasons. We don't find that differentiation in the subsequent job loss sample. And lastly, the survey also, although we don't have longitudinal responses of unbanked status, there is a question about how recently were you unbanked? Was it in the last year? And so in our main specification, we do find effects on being recently unbanked as well as long-term unbanked, which is a little bit surprising, for the causal mechanism we're focusing on. In the percentages there, you can see that the percent as a share of the sample mean of the recently unbanked effect is 256%, whereas the long-term unbanked is 63%. So although there is some effect apparently on the long-term unbanked, which isn't really consistent with our mechanism, it's sort of much smaller in magnitude than what we find for the recently unbanked. Another way of looking at this is looking in the persistence specification. In the persistence, we wouldn't expect those households to say that they were recently unbanked a year later, from if it was directly associated with that job loss. And indeed, we don't find something there in that first column, but in the second column, we do find an effect on longer term unbanked. So the conclusions, we think understanding bank account ownership is a matter of importance for household welfare and public policy. And so we've combined the longitudinal structure of the CPS with the responses in the BFS. And we use differences in timing to mitigate some of the concerns of selection bias, though there's still some challenges we have with the sample size. And so we find evidence of job loss contributing to unbanked status. And so that transition may worsen a household's financial circumstances just when they're most strained and might potentially be able to make the most use of a bank account. And so there's been a public policy focus on trying to find the types of accounts that would fit well for this these sort of marginal households. And so our research is just pointing to that taking into consideration changing circumstances like job loss might be especially important. Further work on this topic, we might look into how job entry affects bank account status, and ideally having more longitudinal data on bank account ownership would improve our inferences. Thank you very much.
Great, thank you, Mark. Our discussant is Ken Brevoort from the Federal Reserve Board of Governors.
Let me try sharing my, oops, let's see, I'm having some security issues with sharing my screen. This was not expected. I'm not sure what's going on with my MacBook at the moment. Sorry, this is,
Maybe you could, do you want to email the slides to either Brune or to me?
Sure, let me try that. So actually, I'll do it without slides rather than sort of holding everybody up. I'm not sure why it won't let me give Zoom permission to access my screen. Sorry about that. I had a problem with my MacBook recently, and it ended up causing me to have to take everything back to its initial factory presets and sort of do everything from there. So thank you for having me here. I'm very happy to be here to discuss what I thought was a very interesting paper that Mark just did a really nice job of talking about. I should point out before I start that any opinions I express in this talk are my own and do not necessarily reflect those of the Federal Reserve Board or its staff. And I apologize for the snafu with the slides. So what I wanted to do is I wanted to start out by talking about sort of why it is we care about bank account ownership. I actually think Mark did a nice job of talking about this in the presentation. I thought the paper was a little bit lighter on it, so I wanted to make sure people have an idea of exactly why it is we care about this. And really, we care about it for a number of different reasons, part of which is just the fact that having a bank account is important for one's financial health, right? It gives you access to the payment system, it gives you a ready means to save, and also helps you avoid having to spend money on alternative financial services like paying for check cashing services, taking out loans through a pawn shop. But I think there's other aspects of bank account ownership that I think we don't quite understand as well, but that also could be really important. And these are areas that I've worked in a bunch. And that is in particular that when you think about people who are sort of on the margin of credit reporting systems, who are credit invisible or who don't have very thick credit files, a lot of times the means by which they obtain access to credit is through alternative sources of data that may very well rely on bank account ownership, right? So the primary reason, or the primary way in which most people establish a credit report is by opening up a credit card in their own name. And the most likely avenue they're able to do this without having a credit history is that you've got a bank that knows they've been a customer with a bank account for a while, and based upon that information, even though they don't have a credit history, allows them access to the credit reporting system, or allows them to have a credit card, which then gives them an account in the credit reporting system. So it's also going to be important for credit access. And in some ways, it's also going to be important in other ways to credit access. So for example, one of the slides I was about to put up was a slide talking about a new program by Fannie Mae. You may have heard about this back in August, where Fannie Mae was changing its underwriting policies in a way that was going to give credit for rental payment histories going back. So people who've been renting houses in the past who want to buy houses now, they can use their past history of showing rental payments to qualify for the loans. One of the things that wasn't really talked about in the press release and the news stories that were written about this is the fact that where Fannie Mae is getting the information is from the bank accounts of these individuals. So they have access to asset data that they're getting from a third-party aggregator, who, when you apply for credit, you can check a button, it will pull down your bank account history, and they'll be able to see whether you made the payments on your rent using your checking account or not. So when these consumers wind up losing access to a banking account, they are going to effectively not only lose sort of their ability to pay those rents with the payment history, but they're going to lose that entire payment history going back, right? So this disruption in the history of payments is potentially going to have real effects on credit access as well. So I think this issue about looking at sort of the extent to which job loss leads people to lose their bank account access is not only going to have the effects that it has sort of while they're unemployed and have lost the account, but it also potentially is going to help prevent them from moving into home ownership and things like this, because in a lot of cases, you basically need 12 months of payment history or 12 months of checking account history in order to get a lot of these benefits, like access to the underwriting situation. All right, so in terms of what the paper does, Mark just did a very nice job of it. Basically, it combines data from the FDIC's survey of household use and banking and financial services, along with data from the CPS, the monthly current population survey. And then it evaluates how job loss, as observed in the CPS, correlates with the likelihood of having a banking account from the BFS survey. And it's going to make two comparisons between two different groups. It's going to take the people who have recently experienced a job loss, and it's going to compare them to the population who remained employed over that same period, and look at the likelihood of having a bank account across those two. Obviously, the people who are recently unemployed are not going to be a random sample from people who are not going to be sort of, they're going to differ in systematic ways from people who remained unemployed. So the paper uses also a really interesting approach, I think. I quite liked it a lot, of also comparing people who recently lost a job to people who 12 months from now, over the same months, are going to lose a job, and do the comparison there in the hopes that a lot of the sort of idiosyncratic differences of people who experience job loss are going to be much more similar between the people who've recently lost a job and the people who lose a job in 12 months. And in terms of what the paper finds, the numbers the paper finds are actually really quite eye-popping in terms of the effects the job loss seems to have on the probability of being unbanked. So if you have a recent job loss, your likelihood of having a bank account is going to go down by about 12.5 percentage points. And that's when they compare the people who had recent job loss to the people who remained employed. If they do the comparison between the people who had recent job loss and those who were subsequently unemployed, the effect is even larger. It's about 17.7 percentage points. And the other things that they find in this paper really are sort of similar magnitudes, but they're also the different ways that sort of are very intuitive, right? So the effects are much more pronounced for households who have incomes below $20,000. And they're much more pronounced for Black households as well. Particularly with Black households, when they find that effect when the comparison is made between the treated group and the subsequently unemployed group. But they also find persistent effects of about 5.9 percentage points that occur after a year, and those are driven by people who remain unemployed for that entire year period. And of course, they also find, as Mark said, increases in the use of alternative financial services. So your prepaid cards, your money orders, your checking cashing services, and your pawn shops. So a lot of the services that people have to rely on when they lose access to a banking account, they wind up using more heavily after that.
One more minute, Ken.
Okay. And so the one thing I did want to sort of highlight, the one concern I had when looking at the paper is I really like this idea of comparing people who remained unemployed to people, or sorry, people who were recently unemployed to people who are subsequently unemployed. But when you look at the summary statistics, there's a lot of reasons to be concerned about that comparison. I would have expected the population characteristics of the people who were subsequently unemployed to be a lot closer to the people who were recently unemployed than to the population that remained employed. And in fact, a lot of cases, there's the difference between the treatment group and the subsequently employed is more different than it is than when you do the comparison based on the remained employed. In particular, the population that is subsequently unemployed is noticeably older, it is noticeably whiter, it is twice as likely to be married, and 50% of the observations for that group come from the 2019 FDIC survey, which, if I understand the way they've created the sample correctly, means that they're looking at people who were unemployed in 2020, which of course would have been during the first year of the COVID pandemic. So I think there's a lot of reason to believe that that subsequently employed category might not necessarily be as representative or capturing the same pool of people as the recently employed. And I don't want to dwell on that too much, but in terms of sort of where I would go from here. And my conclusions, I think the authors have written a very well-crafted paper on an important policy relevant topic. I think they've done a really admirable job of sort of trying to deal with some of the unobserved variation that might be there. And they basically find that job losses had large effects on the likelihood of being unbanked, but they're not implausibly large. They're sort of large and important, but they're believable. And as suggestions, I would again just decide to suggest a deeper dive into this difference between job loss and subsequent job loss categories. And maybe look to the extent that they're able to at the effect of, or the differences that may have emerged if those bank account losses were voluntary versus involuntary. Thank you.
Great, thank you, Ken. I'll share one question from the chat, and it was about whether the data include, in particular, this is from Mark Lee, about the person level findings. And he was wondering whether the results are picking up differences between single person and multi-person households. And whether you could look at heterogeneity based on whether it was a family household or a non-family household. And another question related, asked about issues of job loss around divorce and splitting of households and so forth. So is that something you've looked into, Mark?
So we've looked at job loss in single person households, and we actually find the largest effects for job loss in single person households. So it's as if, there's less of a fallback when there's no one else, or single employed person households specifically we looked at. There's less of a fallback than if there's another employed person in the household. We don't know specifically for these if it was a joint account. I don't believe, I might have to confirm that, but we find, actually stronger effects in single person households. And regarding the second question, I think that's a good point about looking into like other household changes that are occurring as a result of the job loss and trying to understand that. We've found similar effects if we look at households that have no attrition and households that have attrition, which would somewhat address issues related to divorce or separation, I think. But that's understanding that more would be helpful. And for the reasons associated with job loss from the 2013 survey, from Alicia's comment, we found that households that said that they had become unbanked because they recently experienced job loss, we found that response of that they had recently experienced job loss aligned with what we're seeing in the longitudinal monthly CPS data. Ken makes lots of great comments, and we'll have to get back to him about those, and especially this issue about thinking about the pandemic and how that might affect that sample is something we'll need to look into a little bit more. But thanks a lot.
Thanks, Mark. Great. We'll transition to the next paper. Our presenter is John Creamer from the Census Bureau, presenting on the unbanked and impoverished.
Sorry, I forgot to unmute myself and then couldn't find the mute button. Cool. Well, I appreciate the opportunity to present our paper today. It's joint work with Lewis Warren, and the usual Census Bureau disclosure avoidance disclaimer applies here. So these are our views and not the views of the Census Bureau. All of the data that we're using currently today in the analysis is publicly available. We have a disclosure number because in our working paper that hopefully will be coming out soon, we apply some results using internal SIP data to create measures or estimates with the supplemental poverty measure. So as Mark kind of talked about well in talking about the FDIC supplement, the CPS FDIC supplement in 2021, when it was released, showed that 5.4% of households in 2019 in the United States lacked a checking or savings account. And he discussed, and Ken as well discussed, the importance of having a bank account and not having to access costly financial alternatives. So what we're going to kind of focus on more today is the disparities that we see both by income and race and Hispanic origin. So in 2019, Black and Hispanic households had unbanked rates, which were approximately 5 times greater than white households. And when we're talking about Black and white, we're talking about Black non-Hispanic and white non-Hispanic. So there's not really the crossover in groups there. Nearly 16% of households with less than $30,000 in income were unbanked. And some of the existing literature has focused on examining the characteristics of the unbanked and the reasons why people are unbanked at specific points in time. But there's fewer examples of kind of looking at the relationship between poverty status and raw income. And that's an important difference because with poverty status, you're capturing kind of a slightly different metric since you have equivalent scales being placed on the thresholds to take into account household compositions. And when we're thinking about the supplemental poverty measures, there's some adjustments made for geography and for home tenure. And so in this paper, what we're doing is using 3 nationally representative household surveys to track unbanked rates from the 1980s to the present period up to 2019. The 3 surveys that we're using is the Survey of Consumer Finances from the Federal Reserve, the Survey of Income and Program Participation from the Census Bureau, and then we're linking data from the CPS ASEC, which comes out in March annually, or the surveys taken in March annually, and the FDIC supplement, which Mark just explained the survey structure, the schedule. We're going to interact unbanked rates with poverty status, race, and Hispanic origin to examine inequalities across these characteristics. And then at the end, we're going to decompose Black, white, and Hispanic white differences in unbanked rates to kind of get a picture of what are the explained components and the unexplained components, and then use some features of the FDIC supplement to dig into that a little more. So the snapshot of our results are that while unbanked rates have fallen by 9 percentage points on average across the 3 surveys from 1983 to the present time, inequalities are still present and stable over time between white households and white individuals and Black and Hispanic individuals. So unbanked rates are currently 8 times higher for those in poverty compared to those not in poverty, while Blacks and Hispanics have unbanked rates 4 to 5 times higher than whites. And about 40 to 50% of the unbanked were in poverty across the period examined. And this is nearly twice as large as the share of those in poverty who are unbanked. In the more recent time period in the 2010s, the returns to characteristics account for approximately half of the Black and white and Hispanic white difference in unbanked rates. So that means that there's the other half is by unexplained factors. And when we're digging into the reasons why individuals are unbanked, we're finding that the minimum balance requirements, that's one of the responses to the FDIC supplement question. This is the most cited reason by quite a long shot for why people are unbanked. And when we're looking at like the entire population shares and not just the population that is unbanked, we're seeing that Hispanics and Blacks are 5 to 7 times more likely than whites to report that the minimum balance requirements are the one is the key factor, the main cited reason for not being unbanked. So to give you a little more detail on the SCF and the Survey of Income and Program Participation and our linkage between the FDIC supplement and the CPS ASEC, you can see across the top row our time period. So for most of for the entire series, we're using the SCF, which is a triennial survey from 1983 to 2019. SIP is 1984 to 2017. If you've seen maybe recently from the Census Bureau, the most recent estimates of SIP are actually up to 2019. They were released last week. So you can look forward in the future to us having those estimates, just haven't been able to turn it around in a week. And then finally, we're using the FDIC supplement merged with the ASAC from 2009 to 2019. The samples are slightly different across the three surveys. So the SCF is more, they're sampling at the primary economic unit level. So it's more of a household type measure, while for the SIP and the FDIC ASAC, we're using the sample size to get a little more, to focus more on an individual level. When we're thinking about poverty status, we're looking at the household level in terms of the sharing unit instead of the family level, which is used for the official poverty measure. And our unbanked indicator in this case across the three surveys is that the household has no checking, savings, or savings accounts in the FDIC ASAC, because that's what the question is. And then in the SCF and the SIP, we're keeping the same definition, and then also extending the money market account, since that there's information on the surveys about that. And then the last thing to note is just so you can see the sample size across the bottom. So for the modern period, which is kind of our analytic sample, the SCF is the smallest because it's just at the respondent level, whereas we're using the individuals in the SIP and then also in our linked FDIC ASAC sample. And so we're just going to do a descriptive analysis to start with to present the historical series across 1983 to 2019. And just to kind of emphasize, we're looking at the individual level. And the assumption that we're making in this case, since it's a household supplement, is that if we're including partners to the household respondent, children, that sort of thing, people who are not eligible for the FDIC supplement, we're assuming that they, if the household is unbanked, they do not have access to a bank account. And so we're stratifying our descriptive analysis by race, Hispanic origin, and poverty status. And then finally, we're going to use the Catawba-Oaxaca blinder decomposition to look at those final, to look at the more modern period. And so our first figure that we'll look at is just the entire time series for unbanked rates from 1983 to the present. The blue squares are the SCF, the orange triangles are SIP, and then the green at the end of the period, which we'll focus on in a moment, are the FDIC ASAC. Just as you'll see this on the historical series going forward, that from 1996 until 2013 with the SIP, the triangles are not filled in. And that's indicative of the SIP there were some changes to the SIP during that time that did a worse job of capturing assets for households in the SIP. And there's been a wealth of literature that has looked at the differences in that. So we're just they're there. We don't want to hide them, but those estimates need to be taken with caution. So looking over the entire period, we're seeing that there's the general trend downwards from the average rates that we're seeing in the 1980s, which are about 15%, declining to nearly 5% in the most recent period. And the nice thing, that one advantage that we get from using the three surveys, is that we can kind of validate the estimates across each other. So when we're looking at the more recent period, when we have data for all 3 years, we can kind of see that they're all capturing the general downward slope. And as we get closer and closer to the present time, they're actually getting similar estimates. So this is a good thing in terms of our survey validity if three surveys are kind of coming up with the same answer. When we're looking at race and Hispanic origin across the same period, we see that unbanked rates for whites are much lower than Blacks and Hispanics. While the rate of change is slower for whites, since it's at their level differences, the shares are similar. So we're still seeing the differences in magnitude. So if we're looking at the 1980s for whites compared to Blacks, we're seeing that unbanked rates are about 4 times higher than whites, and that continues in the more recent period. And when we're looking at the specific surveys in modern times, you can see, again, the three surveys are kind of pointing in the same direction. And then we next look at in poverty and not in poverty. So unbanked rates are higher for those not in poverty, and you can still see the general downward trend, but still, as we're getting to the modern period, there's large differences between groups. So in 2019, we're seeing about an average of 25% of the individuals who are in poverty are unbanked, while it is much lower, around 5% for those not in poverty. And the level differences, again, are present when we're focused on the modern period. And you actually see there's more stability in unbanked rates for those in poverty across from 2013 onwards. And then we'll do the same looking at white, Black, and Hispanic individuals. And we're seeing similar trends over the time series. And then when we're also looking at the more modern time series. And then finally, for those not in poverty, it's a little more noisy, as you can see. But again, the story mainly the same is that we're seeing consistent declines in unbanked rates. And while this is obviously a good thing when we're thinking about the benefits of people get the benefits that people receive from their bank accounts, we're still seeing large disparities amongst the groups even as time progresses. So unbanked rates, as a summary, have declined from the 1980s to now, but they're still 4 to 5 times higher for Blacks and Hispanics than whites. The rates increase across the board when poverty status is considered, and 40 to 50% of the unbanked were in poverty across the period examined. Unbanked rates for Blacks and Hispanics have also declined. Like, I think I kind of passed over it quite quickly when I was looking at the graphs, focusing more on the trends, but the estimates that we're actually showing is that for those in poverty, Blacks and Hispanics, like 75% of those people were in poverty. So like very huge magnitudes that we're thinking about in the 1980s. So these declines are very significant, even just in magnitudes. And it's still a third of those in poverty are still unbanked in the more recent time period. And so we'll focus more on this analytic sample from 2013 onwards. And we'll just look at the unbanked rates for the different characteristics that we're kind of considering. So these statistics aren't that groundbreaking from what we have seen before, but when we look at some of the controls that we're going to be looking at in our decomposition analysis shortly, you see that unbanked rates between females and males are similar. Married individuals are more likely to be unbanked than those who are not married. Those more educated individuals are more likely to be banked than those without a high school degree. So it kind of falls along those, what you would say are kind of the economic lines of being in better health, better educated, that sort of thing. And then lastly, an interesting result when we're looking across region is that we're seeing that the South has slightly higher unbanked rates than the other regions in the United States. And so to quickly explain the decomposition model that we're looking at, we're using a nonlinear probit model in the Catawba-Oaxaca Blinder framework to decompose these gaps. And we're using a pooled specification, so we can kind of simply say we're looking at the explained component and the unexplained component. The explained component can be understood as differences in characteristics, so thinking about differences in education levels, raw income to poverty ratios, that sort of thing, whilst the unexplained components can be understood as the difference in returns of these characteristics. In some cases, this has been described as discrimination or other unobserved factors such as network effects and that sort of thing. And so looking at the full table result here, where on the left side, we have Black and white decompositions for the 3 surveys. And on the right side, we have Hispanic white decomposition. So we'll focus first on the Black and white decompositions. And for the time period from 2013 to 2019, we're seeing that the differences in unbanked rates are between 12 to 14 percentage points. And you can see across the 3 surveys that the unexplained component is slightly larger for those Black and white, and we're focusing just on Black and white individuals in these specifications. And then for those for the Hispanic white decompositions, we actually see the opposite story in the SCF and the SIP, where the explained component is larger than the unexplained component. So the differences in characteristics is driving the difference, and we're seeing a slightly different story in the FDIC ASEC, where it's capturing a bigger overall difference for unbanked rates in Hispanics. And as a result, even though the explained component is similar in magnitude, you're actually getting a bigger unexplained component. So it's more of a 50-50 split in that case. When we focus doing the same thing, but focusing on the subsample and poverty, what we see is obviously larger magnitudes across the board, but a similar story where the unexplained component is the bigger contribution. And for Hispanics, the Hispanic white decomposition, the magnitudes increase, but the story becomes a little more consistent across the board, where the explained component is larger for the 3 surveys. And so from just as a quick discussion of these results, for the most detailed models, less than half the difference in Black and white unbanked rates on average can be attributed to these differences in characteristics, while just over half of the difference in the Hispanic white unbanked rates can be attributed to the differences in characteristics. And then we know, just as I was saying, that the FDIC ASEC has a larger overall difference, but it's a similar coefficient on the explained component. So it could be that there's an omitted variable problem that we have just with our survey, or it's something that we're picking up in the sample being slightly different, or perhaps our reweighting procedure is doing just something that is kind of changing the effect in that specific survey. And so the subsample and poverty, it's a similar story, just with larger magnitudes. So we'll try to dig into this unexplained component by focusing on why people are unbanked. So if we're kind of thinking of this unexplained component as like maybe market forces or supply and demand side issues, like having that question is a good way to get at it. So while we focus mainly on the FDIC ASEC in this section because it has a bit more of a sample size across that compared to the SCF, which has similar questions. And the specific question is, there are different reasons people might not have a checking or savings account, and do any of the following reasons apply to you or others in the household? So in this case, in table 6, what we're seeing is that on the left side, you have the share of the unbanked, whereas on the right side is the share of the entire population. And then we have the 4 top reasons why individuals report that they're unbanked. So when we're looking at the share of the unbanked on the left side, we're seeing that 42% of the unbanked population is reporting that the minimum balance requirement is the primary reason, followed by people not trusting banks with about 17% of the sample. Fees are too high at 11%, and then different identification, credit, or former bank account concerns comes in fourth at 8.6%. When we're looking across the different race and Hispanic origin groups, we see that the minimum balance requirement is more reported for Black, slightly less for Hispanic, and the bigger kind of in the reverse, the bigger difference for Hispanics is when you're looking at the bottom row, with cannot open an account due to personal identification, credit, or former bank account, where the percentage of Hispanics who report this reason is about twice as high as whites and 3 times as high for those for Blacks. When we're looking at the share of the population, I think this is kind of like an interesting figure since it's the overall population. And it's 5% of Hispanics and 7% of Blacks are reporting, when you're just looking at the entire population, are saying that the reason why they don't have a bank account is because of these minimum balance requirements. So it's actually a pretty substantial portion of the population that is reporting this. And similar to what we saw with the decomposition results, the magnitudes increase when you look at the subsample in poverty. So 56% of households or of individuals, of Black individuals who are in poverty and unbanked report that it's because they don't meet the minimum balance requirements. And then we see similar trends for the other categories where it's don't trust banks, bank account fees are too high, et cetera. And then when we're looking at the share of the population, again, it's just a pretty large proportion of the population is reporting that they don't have a bank account, and it's because of the minimum balance requirements. So for Blacks, it's 22%, and for Hispanics, it's 14%. And so just to kind of summarize that, the primary reason that most people are reporting is that they're unbanked is because they don't have enough money to meet a minimum balance. And this is not necessarily a demand side issue, it's sort of a supply side issue where there's kind of barriers to entry for individuals trying to get their bank accounts. And it's followed by a mix of issues that kind of go back and forth, whether they're supply side or demand side. Hispanics are more likely to cite that they have issues with identification or other problems. And then, like I was just saying, the results are pointing towards barriers to entry, which are affecting the returns to characteristics in the decompositions. So if we're kind of thinking of it from a policy perspective, barriers to entry are an important story. It's not just bank locations and things that have been theorized before. And so finally, some takeaways. Cool. For some takeaways, like I said, we're seeing these large decreases in unbanked rates over time from the 1980s, but the inequalities that we've seen across time have basically are kind of like, they've been persistent across this time period, especially for those in poverty compared to those not in poverty, where rates are 8 times higher. And then finally, Blacks and Hispanics have unbanked rates that are 4 to 5 times higher than whites. And then decomposing these differences shows that a large share of the differences can be attributed to these returns to characteristics, and a lack of money is the primary reason why these individuals are unbanked. So altogether, I think the moral of our story is that while people are gaining access to bank accounts as time has progressed, there's still important disparities that we need to consider when we're thinking about increasing access to banks and those sorts of things. So I thank everyone for your time today, for listening, and here's our contact information if you'd like to reach out with any questions or anything. Thanks.
Thank you, John. Our discussant is Jeffrey Weinstein from the FDIC.
Okay, great. Let me share my slides. Can everyone see my slides? Okay, great. So, yes, I'm going to be discussing John's paper. Most importantly, getting this out of the way, the views and opinions expressed here are solely my own and do not necessarily reflect the views of the FDIC or the United States. All right, so just briefly to summarize the study. So this study documents differences in rates of bank account ownership between 1983 and 2019 across poverty status, race, and ethnicity. It also provides insight into what can explain these differences in unbanked rates for the period 2013 to 2019. The paper does this in 3 ways, estimates differences in unbanked rates across socioeconomic characteristics, demographic characteristics, and geography. Uses the Catawba-Oaxaca blinder decompositions to estimate how much of the racial and ethnic differences in unbanked rates can be attributed to differences in observable characteristics and how much is unexplained by these characteristics. And then also examines self-reported reasons for not having a bank account. All right, so the data used in the study are 3 nationally representative household surveys, the 1983 to 2019 surveys of consumer finances, 13 waves, the 1984 to 2017 surveys of income and program participation, 29 years of data, and the 2009 to 2019 FDIC supplements to the current population survey linked to the annual social and economic supplements, the ASEC, and there are 6 years of data here. All right, so the main findings are sharp declines in unbanked rates over time for Blacks, Hispanics, and whites, though unbanked rates continue to be much higher among Blacks and Hispanics. Higher unbanked rates for households in poverty with rates that have fallen over time. Based on the decompositions for the period 2013 to 2019, observable characteristics were able to explain approximately half of the Black, white, and Hispanic white disparities in unbanked rates. And not having enough money to meet minimum balance requirements and not trusting banks were the 2 most cited main reasons for not having a bank account. All right, in terms of getting into my comments, well, first I want to say I enjoyed reading this paper. I've done research on racial and ethnic disparities in use of financial services, so that this paper definitely fit along with my interests. A large portion of my work at the FDIC involves analyzing the FDIC supplement, doing the data analysis, and then also working on the design of the instrument. So it's, of course, nice to see research done using that data set. It addresses important policy questions. For example, the need for targeted strategies that address barriers to bank account ownership for population segments with high unbanked rates, and also that such strategies should focus not only on opening an account, but also on maintaining an account. Okay, so here are my here are some thoughts I have, some comments on the work. So first I want to say a little bit about poverty status versus household income. So the paper argues that poverty status is preferable to household income. For example, poverty status accounts for household size where household income does not. And that makes a lot of sense. But I just wanted to comment though, since trends in unbanked rates by poverty status are similar to trends in unbanked rates by household income, which we've shown at the FDIC and the paper has shown as well, that it may be possible to simplify the analysis by focusing on household income. And so one example is that since the base CPS includes income, linking the FDIC supplement to the ASIC may not be necessary in that case. So again, the analysis could be simpler. The sample size could also go up. So I guess I would just suggest that that the authors provide additional justification for using poverty status instead of household income in the paper. I also wanted to comment on the level of analysis, household versus individual. So most of the analysis in the paper is at the individual level. I'm just thinking that household level analysis may be more appropriate. For example, household members who do not have an account themselves may benefit from another household member's account. And in addition, as this was mentioned during the talk, the FDIC supplement questions on reasons for not having a bank account are asked at the household level. Do any of these reasons apply to you or others in your household? Blah, 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 blah. Of course, one issue with using household level data is that some characteristics vary at the person level, like education. So some assumption would have to be made, such as using the characteristics of the reference person to represent the household. And just as an aside, I don't know if it was explicitly mentioned in the paper, but does your analysis use household level bank account ownership, which is collected in all supplements, or the individual level bank account ownership, which is collected in all supplements except for the first one? Just aside, I believe it uses the household level, but I just thought I thought maybe that should just be clarified in the paper a little bit better there. All right, just some additional thoughts on other measures in the supplement. So Mark Kutzbach talked a lot about this during his presentation, so I can go through some of this quickly. So the supplement, in addition to bank account ownership, collects data on many other things like income volatility, account access methods like tellers or mobile banking, smartphone and home internet access, and use of prepaid cards, non-bank financial transactions, and credit. It may be useful to analyze one or more of these measures. For example, the introduction and conclusion of the paper talk about direct deposit. We know that some consumers may use general purpose reloadable prepaid cards for financial transactions, such as receiving direct deposits. We find that use of prepaid cards is more common among unbanked households. And so for just to put this into some context, the GAO found that as of March 31st of last year, 3.6 million of the about 160 million economic impact payments authorized by the CARES Act were made by prepaid card. And I provide the reference here, and I'll send you these slides after the talk.
About 1 more minute, Jeffrey.
Okay, great. Yeah, this is my last slide. So just a couple further thoughts. So in the conclusion, when discussing consequences of reducing or removing minimum balances, you may want to review the following documents, which provide guidance on offering bank accounts designed to meet the needs of underserved consumers. For example, the FDIC's Model Safe Accounts template, and also Bank on National Account Standards established by Cities for Financial Empowerment. That could provide some motivation there. One possible extension, which you mentioned, which you talked about geography, I think it would be interesting to see if the results differ by geography using the SIP and the FDIC ASEC data, because geography wouldn't be available in the public SCF data, especially for the South where the unbanked rate is the highest. And then the last comment, just something minor about, just something for you to double check regarding unbanked reasons. I know in your analysis, you combined 2013 and 2019, and in some of the later years, we split out some questions, but we split out 2 of the unbanked reasons, but it looks like they're split out in your analysis table, but in 2013, they were asked as a separate question. So that's just something just a more minor comment just to review when you have a chance. And otherwise, great. Well, thank you very much for asking me to discuss this paper. Very interested in reading it now and seeing seeing the next versions of it.
Great. Thank you, Jeffrey. In the interest of time, I'll transition straight into our final paper to make sure they have sufficient time. So we'll have Shalise Iramlu presenting from the Census Bureau about unbanked households' engagement with the tax system.
Thank you, Brian. Let me just share my screen. All right. Okay, hi everyone. Thank you so much for attending this seminar. This is a joint paper with Mark Lee, and we're both from Census Bureau. So the standard Census Bureau disclaimer applies. All the views expressed in this presentation are those of Mark and I and don't necessarily represent Census Bureau's views. All errors are also ours, but hopefully you'll be hard-pressed to find any. This presentation also complies with the disclosure avoidance guidelines at Census Bureau. State and federal agencies disperse billions of assistance dollars to eligible participants every year. But eligibility is often in large part determined by financial records such as bank statements, tax returns, asset statements. So that means that eligible households who are unbanked may miss out on these benefits that they potentially need the most. So we saw an example of how financial records can affect verifying eligibility and disbursement of aid during the COVID pandemic. The adjusted gross income on the most recent tax return in 2019 or 2018 determined eligibility for stimulus payments. Also, if there were any direct deposit information on the tax returns, the IRS used that information to electronically deposit the stimulus payments. Otherwise, a paper check was mailed to the eligible households. So that meant that non-filers and unbanked households experienced delays. And it wasn't until much later in the process, towards the end of the second round of stimulus payments, that the IRS began dispersing the aid on prepaid debit cards. Another example of financial records importance in disbursement of aid can be seen in the trends taken by some of the most prominent social safety net programs in providing an option of disbursement for unbanked households. So Supplemental Nutrition Assistance Program, nutrition program for women, infants, and children, temporary assistance for needy families, unemployment compensation, Social Security and Veterans Benefit all have options of dispersing benefits via electronic benefit transfer cards or prepaid debit cards. EBT cards are very similar to prepaid debit cards, with the exception that they can only be used at specific participating merchants, versus prepaid debit cards can be used anywhere. But despite these efforts, if unbanked households engage in economic activities that are less formal, then program administrators are less able to target eligible non-participants and verify applicants' eligibility. Economic activities of unbanked households are also important in determining their tax compliance by IRS. So if unbanked households' activity is less formal and is less likely to generate third-party reporting to the IRS, then IRS is less able to determine whether these households owe anything in taxes and whether they should file taxes in the first place. Of course, given the transaction cost of having to cash a tax refund, given that unbanked households don't have a bank account and would have to use alternative financial services, or paying tax on their payments, all lower unbanked households' incentives to voluntary tax, file tax returns. So what is our research question? What is it that we ask in this paper? If the defining characteristics of unbanked households is their lack of engagement with the financial system, then to what extent does that lack of engagement carry over to the tax system and the social safety net? And to the extent that we can observe unbanked households in the administrative data, how does their engagement compare to that of the banked households? And what can we learn about unbanked households' economic activity? To look at the social safety net coverage, we compare program take-up between banked and unbanked households. Of course, those households who take up benefits are eligible, but there might be people who are eligible but don't take up benefits. At the same time, there are people who apply for benefits and then are rejected, perhaps because they're ineligible, and we can also observe those people. So if the take-up of benefits among eligible unbanked households is less than the take-up by banked households, then perhaps the program outreach efforts hasn't been as effective as we would have hoped. But we also look at the engagement in the tax system, looking at other financial records and tax filings. So we compare the incidence of tax filings by bank status, the presence of a W-2 form, different type of 1040 schedules, paid mortgage interest of $600 or more, and other types of information returns. Unbanked status needs to be determined using survey data. The only administrative data that we have that can hint at unbanked status would be actually the Social Security Administration database that has an indicator for whether someone received their benefits via a direct deposit or whether the benefits were dispersed via prepaid debit cards. But of course, banked households can also opt into receiving their benefits via prepaid debit cards. So that's an imperfect way of identifying unbanked households. Fortunately, we have 3 nationally representative surveys, as both John and Mark discussed some of them. So we have the current population survey, unbanked and underbanked supplement sponsored by the Federal Deposit Insurance Corporation. We have the survey of consumer finances sponsored by the Federal Reserve Board of Governors. And we have the survey of income program participation by Census Bureau. We use the survey of income program participation to identify unbanked households, those who don't have any checkings account, savings account, money market accounts, or certificates of deposits. So this definition is slightly different than how Mark defined their unbanked households in their paper. And then we use our survey of income program participation and unbanked households that we identify, and we'll link them to a set of administrative data. Today, we'll show you results from linking the data, the SIP data, to the Supplemental Nutrition Assistance Program, SNAP, and Temporary Assistance for Needy Families, TANF, as well as a universe of 1040 schedules and information return master files. What we have done, but for the sake of time, we're not going to get into today, is linking the data to the protected identification keys, or PICs, which are almost always necessary for linking to administrative data, for linking to most administrative data. And therefore, they can determine how much we can learn about unbanked households in the admin records. We also link the data to the detailed earnings records, which is the set of W-2s for people with a social security number and a 1040 SE schedule for self-employed people, as well as a NUMIDN file, which is a numerical identification database for the Social Security Administration on anyone with a social security number. What is on our to-do list is to expand our TANF data, as well as our data on other social safety net programs, such as the old age survivors and disability insurance, supplemental security income, and nutrition programs for women, infants, and children. So for the SNAP and TANF data, we receive monthly state-level data. We have 8 states that provide us their SNAP information. And we have another 11 states that give us a SNAP or TANF program participation. For these states, we only focus on active cases and the benefit amounts granted to these cases. For these programs, there are gross and net income eligibility limits. If households have an elderly person living with them or someone with a disability, then the gross income limits are waived and they would only have to satisfy the net income eligibility limits. And to give you an idea of what those eligibility limits were in 2017, for most states in 2017, which is the year we're looking at, the net income eligibility for a one-person household was $990 a month. And for a two-person household, that limit was $1,335. But of course, there is some variation by state. There's also asset eligibility requirements that research has shown that disincentivizes people from having a bank account or keeping their assets in a bank account. Undocumented immigrants are not eligible under federal funds. There is some variation by state where they waive this requirement and allocate non-federal funds to undocumented immigrants. Immigrants in general are, however, eligible for participation, but they have to meet stricter eligibility requirement that also varies by state. We also link the Survey of Income Program participation to the 1040 returns master files, which has indicator variables for different types of incomes and 1040 schedules filed. We don't have any income levels, just different types, the presence of different income types and schedules filed. If we have multiple returns for a person in 2017, we'll take the latest one. And the way that we, today, the results that we're showing, we use the PICs, the protected identification keys, to link our survey to all of this administrative data. And just so that you know a little bit about PICs if you don't already, those are assigned as unique identifiers to survey respondents via a probabilistic matching algorithm that compares their survey responses to age, sex, and address, and compares that information to information on their tax returns and applications for Social Security numbers. We also link the data to information return master files, which give us indicators for reporting of miscellaneous income, such as prizes or royalty income, income from retirement plans, income from government, federal, state, or local level, income from real estate, the universe of W-2s, so W-2s for anyone with a tax identification number, regardless of their Social Security number, whether they have Social Security or not. Income from Social Security benefits or railroad retirement benefits, interest on bank accounts, or dividends on capital gains of $10 or more, and paid mortgage interest of $600 or more. So what this graph is showing is that people who qualify for most benefits tend to be unbanked. So the x-axis is showing the distribution of SNAP and TANF benefits, annual benefits, by decile, and the y-axis is showing the share of unbanked at each of those deciles. And we see that at the higher end of the distribution, higher benefit levels, we have a higher share of unbanked. So at the 90th percentile of benefits or the 10th percentile of benefits, 41% or 44% of the recipients are unbanked versus the 10th percentile of benefits, where only 25% of recipients are unbanked. Switching gears quickly and looking at engagement with the tax system and other financial record, the presence of other financial records. For unbanked households, we're running a set of regressions here where the dependent variables are indicator variables for presence of any different types of income. Our regressor of interest is an indicator variable for being unbanked, and we have a set of control variables for race, ethnicity, proxy responses, program participation, and income. These are household level regressions, and the race and ethnicity, and I just want to mention this because Jeffrey made a comment, the race and demographic variables that we control for are aggregated at the household level. So questions like, is anyone in the household Black? Is anyone in the household Hispanic? But looking at the results, we see that unbanked households are 9.4% less likely to have a tax filer than banked households. They are 4.9% less likely to have any taxable interest income. They are a little bit 1.6% more likely to have a non-taxable interest income. But like an example of a non-taxable interest income would be municipal bonds. So they do engage and they have some financial records, but municipal bonds, just a little bit. They are also less likely, 2.5% less likely to have any Social Security income, but they are 14.8% to have earned income tax credit. And to qualify and be even considered for earned income tax credit, you must file tax returns. So there is evidence that they do engage in the tax system, but it seems like they have less of every single type of income for the most part, perhaps other than transfer income. Here we have, again, set of regressions where the dependent variable is a natural log of different types of income. We have the same regressor of interest and control variables. And we see that unbanked households earn 45% less in wages and salaries than banked households. They also earn 25.7% less in earned income tax credit than banked households, even though they were more likely to qualify for it and get it, as we saw in the previous slide. Now looking again, having indicator of dependent variables being indicator variables for a presence of different 1040 schedules, we see that unbanked households are 3.4% less likely to have a Schedule E, which is an itemized tax deduction. We can infer something about home ownership of unbanked households from this measure, because one of the largest deductions that we can make, itemized deductions, would be mortgage interests. And so it seems like if they're less likely to itemize their taxes, then they're less likely to have a mortgage and be a homeowner. They are, however, 4.9% more likely to have a Schedule C, which is for reporting income or loss from a business. And they are 7.2% more likely to file a Schedule SE, which is for reporting net earnings from self-employment. So it seems like maybe they're more likely to be self-employed, and maybe they're more likely to engage in the less formal economy.
About a minute or so more to wrap up.
Awesome. Thank you, Brian. So quickly, because I'm short on time, here we have another set of regressions looking at indicator variables for the presence of information returns. We see that unbanked households are 15.9% less likely to have any information returns, and they have 58% fewer information returns than banked households. They also, in this slide, will see that they have less of every other type of information reports. So 8.8% less for retirement income, 6.6% from government, and so on. So in the presence of time, I'm quickly going to conclude. So it seems like unbanked households are not completely checked out. We do observe them in our SNAP and TANF records. And we do observe them in the 1040 master files and the information return master files, but it seems like they are less engaged in those systems than banked households. It looks like they have less income across different types, except for maybe transfer income. They do appear to be more likely to be self-employed and participating in the informal sector, especially since there are fewer informational returns for them on file. So meaning that they engage in economic activities that is less likely to generate third-party reporting. Thank you so much. I'm happy to take questions by email or afterwards after Maud has a chance to discuss our work. Thank you, everyone.
Thanks, Shalise. Our discussant is Maud Toussaint-Comeau from the Federal Reserve Bank of Chicago.
Well, hi, everyone. It's a real pleasure for me to discuss Shalise and Mark's paper on the unbanked household and their engagement with the tax system and social safety net. So as we know, since the 80s, 90s, when the federal government decided to make all government payment electronic, it was realized that a lot of people did not have an account deposit to deposit the money. So the phenomenon of the unbanked became widely known then. And since then, we have had research on the unbanked. And so the motivation of this research is several. We can move to the next slide. So one, of course, is how being unbanked is an indication of financial exclusion. And that has implication not only for the individuals, but also for a community as a whole. Because from research, we know, especially when we're talking about the unbanked population who are in low-income communities, they generally have less access to formal banking, and there's less bank branches, for example. And this could be a contribution to explaining, in part, why they do not have a financial relationship with a bank and also are unbanked. So such financial exclusion also have other implications, you know, from a balance sheet type of framework, in terms of potentially meaning that these households are not assessing wealth building sort of financial services like, you know, home ownership, etc. And this would matter clearly for family financial stability and their upward economic mobilities. And, you know, so this type of wealth gap could ultimately mean that financial exclusion have an implication on how the economy grows and recovers. So now this paper by Shalise and Mark is motivated by an issue that is very pressing right now, and that is brought about by the pandemic. It is highlighting the link between being unbanked, exclusion from the financial system in terms of the indication of being unbanked, and engagement in social safety net and the tax system. And so as Shalise clearly explained just now, because precisely there is concern that households who are unbanked, you know, this population may have been the ones most likely to have more people missing on receiving stimulus payment, because this population tend to be harder to reach, and potentially it might also be more difficult to establish eligibility for them, because, you know, stimulus money in the beginning was delivered through bank account, and eligibility was based on tax returns. So that's clearly a very important issue that the paper is raising, trying to understand engagement with safety net and being unbanked, and for that population. So if we look at the data and step back a bit, we know that there are several data which provide us with a good picture of the unbanked. So it is without question a huge phenomenon. We've been hearing that throughout the presentations today. And if we look at the FDIC data, for example, as the last year of the surveys in 2019, 5.4% of American households were unbanked, which represented more than 7 million households. And these households more than 50% of them tend to say that they are unlikely to become banked in the next 12 months. So we're talking about really a persistent in the status of unbankedness. So of course, these numbers have huge disparities by demographic groups. So, we really have about 2.5% of white households who are unbanked compared to 13% of Black households who are unbanked. So huge disparity there. And a lot of these, and we can also see even from this picture right here that there's been some improvement over time in terms of the percent of household and the number of households who are unbanked. And research is really showing that a lot of this improvement is essentially highly explained by improvement in socioeconomic circumstances of household in terms of income, home ownership, education, etc. So what this says then in terms of the contribution, next slide, of Charles and Mark paper is that what question should we really be asking of the unbanked population? So I think that we've sort of moved away in terms of thinking about, the unbanked. And I think early it really was looking in terms of the issue from a perspective of financial literacy, financial education. Perhaps we know that potentially there were issues of trust with formal banking institutions. So service deliveries are still important, but the harder problem and issue I think that we're facing now is that it is important to recognize that people mainly lack financial services because they lack income, and possibly not the other way around. So the key problem to solve is how to help people generate more income and become more included in the economy. So Charlize and Mark's paper is really asking the right question by zooming into trying to see what we can learn about the economic activities of the unbanked. And to answer this question, they are making an extremely valuable contribution to our understanding of these activities with their use of administrative data, including tax return information, and linking that, with data from the SIP, a population that, is really low income, that's receiving those sort of transfer payments, precisely to sort of try to understand the relationship between social safety net and being unbanked. So
about
then,
one more minute.
Yes. So the paper, even at its preliminary state, is giving us some compelling results in terms of the economic activities of the unbanked. So the first one is the fact that the unbanked are not completely checked out. So that's very good in terms of social safety net. So we know that a lot of those benefits are received through paper checks and transfer cards, etc. So of course it leaves to question what the cost of the alternative financial services are in cashing checks in alternative financial services versus formal bank. And the second result that I want to raise here that I think is very important and very interesting is the connection that the paper finds between self-employed and being unbanked, and possibly suggestive of households in the informal economy that we really know nothing about. And I think that's sort of the next frontier of research in terms of policy implication, moving to the last slide here, in terms of helping us think about what the biggest policies is in terms of those segments of the population that are persistently excluded from the financial system because they just don't have money, they're not connected to the economy. And I think the paper is sort of driving us to this direction. And, in its final stage, I'm hoping that it will tell us even more about those households in the informal sectors and what policy can really do to make a difference. Thank you very much. It was a pleasure reading the preliminary paper.
Thanks so much, Maud. And so why don't we wrap up there? We're out of time, but let's all thank the SGE and thank all the presenters and discussants today. Really appreciate it. It was really enjoyed the session.
Thank you, everyone.
Thank you, Brian, SGE, and everyone, especially Maud, for discussing our paper.
My pleasure.